What if I tell you that there is a way of multiplying your stock market returns by 4 without actually increasing the risk of your portfolio? I think you'll probably either say that I'm crazy or that I'm selling some kind of snake oil. But in this video, I'm going to show you exactly how to achieve 4 times the returns of the stock market, multiplying your money by 4 when compared to investing in the regular S&P 500 ETF without increasing the risk. Sounds interesting, right? So stick around, I'm going to show you a few different strategies to achieve this. I'll see you in a second. Hey guys, my name is Henry and today I'm going to tell you how to achieve much better returns while using leverage ETFs and not increasing the risk of your portfolio. Yes, there are ways of adding leverage ETFs into your portfolio without increasing the risk. And in this video, we are going to measure the risk according to the drawdowns, total maximum drawdown and average drawdown. That's what usually counts when it comes to risk, right? You don't want to see your portfolio going down. So in this video, at the end of the video, I'm going to show you one strategy that would have drawdowns that are as large as the S&P 500, which is a basket of the 500 best companies in the world, but with 4 times more returns. Sounds crazy, but it's an amazing strategy. Even I was surprised when I learned about it very recently from my community. Okay, so let's talk about it. How do you usually reduce the volatility of your portfolio? You reduce the volatility through diversification. Typically, people add some kind of uncorrelated asset to their portfolio. And if you are investing in leverage ETFs such as S&P 500 leverage ETFs, SSO, UPRO, or NASDAQ 100 leverage ETFs such as QLD and the TQQQ, you need to add, for example, bonds into your portfolio because typically bonds are uncorrelated. So there is a very popular strategy called Hedgefundie's Excellent Adventure. This was a strategy popularized in the Bogleheads forum. And in the meantime, it's so popular that there is even a subreddit called HFEA, which stands for Hedgefundie's Excellent Adventure. And this strategy basically consists into allocating 55% of your portfolio into UPRO, the 3x leverage S&P 500, and 45% to TMF, which is 3x leverage 20-year plus Treasury bond ETF. The thing about allocating 55% into 3x S&P 500 and 45% into 3x government bonds is that typically bonds and the stock market are inversely correlated. For many years in the past, when the stock market went up, bonds kind of go down, and when the stock market crashes or there is a bear market, bonds would go up. So this strategy of allocating 55% UPRO, 45% TMF have worked well for a few years. This Hedgefundie's Excellent Adventure was also popularized by this paper here, the Long-Term Investing in Triple Leverage Exchange Traded Funds. This is a paper from 2020. It was before 2022 when TMF was still performing inversely correlated. And the paper shows that, as you can see in this chart, a combination of TMF and TQQQ would have kind of performed quite well with less volatility. And the chart that should stick most to investors is this one here. This one shows the maximum drawdown. So as you can see, the maximum drawdown of TMF alone is very large, is like close to 50%. The maximum drawdown of TQQQ is also close to 50% for the period that they have analyzed. But when you combine them together, the largest drawdown used to be half of their alone assets, right? Of investing only in TMF or only in TQQ. You combine them both, you are supposed to have less drawdowns, which was supposed to be good, again, until 2022. And the last few years basically broke the bond market, and the bond market is not working as it should. And that's one of the reasons why you need to find better strategies to diversify your portfolio. But the problem is that more recently, bonds are not inversely correlated. They have been going hand in hand with the stock market. And that's why the portfolios that were diversifying across stocks and bonds in 2022 got absolutely destroyed. Okay, let's jump here on my computer, and this is the original post by Hedgefundie's Excellent Adventure, by this guy who was doing this strategy. And as you can see here in 2019, he had $143,000 in this portfolio. And you can see here the allocations was approximately 55% UPRO, 45% TMF. Now, when I backtest this strategy, what we see here is that, yes, there was a period, for the period of like the last 16 years, S&P 500 alone returned $93,000. While UPRO plus TMF returned $258,000. So it returned approximately 3 times more, but the drawdowns are brutal. Look at this. The strategy that is supposed to protect you from drawdowns had a 70% drawdown. So it's not ideal. Look at this red line. It's the TMF UPRO strategy, had a brutal drawdown. So in fact, if Hedgefundie is still doing this strategy, for the last few years, he's actually losing money. Since 2019, he's losing money because of the 2022 bear market, where both UPRO and TMF went down brutally. I have also backtested Hedgefundie's strategy for the last almost 65 years, 64 years, and the results are not impressive at all. S&P 500, if you have invested $10,000, 65 years ago, now you'll have $6.6 million. And if you have invested in UPRO plus TMF, the same $10,000, it will be $6.6 million. So it's almost exactly the same amount of money, almost exactly. The problem is that the UPRO plus TMF strategy had much larger drawdowns. 82% drawdown versus 55%, and the average drawdown was 3 times larger in the leverage ETF strategy. And scrolling down here to the chart, as you can see here, the red line, for long periods of time, the strategy, the Hedgefundie strategy, was underperforming very wide range. So can you still use TMF or TLT, long-term treasury bonds, in a portfolio to diversify away? Well, maybe you can still use some. In fact, at this precise moment, my leverage ETF portfolio is composed of 15% TMF. Honestly, for the last few years, this is just dragging down my portfolio. My portfolio is still doing very well. Over the last 1 year, it returned like close to 70%, which is outstanding for 1 year. But those 15% that I have into TMF are kind of dragging it down, because I could actually have returned over 100% over the last 1 year. Because of TMF, I'm returning only 70%. But still, I still have TMF because I believe that the interest rate sooner or later will go down, and once that happens, TMF will perform well. Maybe in the future bonds will perform better, but I want to present you an even better strategy. I'm going to present you a strategy that is so crazy that will give you 3 times more returns by combining these two assets, and will have the same level of volatility, the same level of drawdowns of the regular S&P 500, but with 3 times more returns. Can you believe me? All right, let's talk about it. This strategy for the last 15 years performed extremely well, and I'm talking about combining your leverage ETFs with BTAL. BTAL is the AGF US Market Neutral Anti-Beta Fund, and it's a fund that is inversely correlated with the stock market. Check this chart that I'm sharing here on the screen. In this chart, as you can see, you have the QQQ in blue and you have the BTAL in red. And as you can see, they are almost the opposite mirror. They do the opposite movements. And here at the bottom, you have the correlation coefficient, which shows that the correlation at the moment is minus 0.9, which means that they are really inversely correlated. And this is what you want in a portfolio when you want to rebalance, when you are investing in risky ETFs such as the TQQQ or QLD. You want to have something that is very uncorrelated. So what will have been the returns of this strategy? Okay, So if you do just the S&P 500, you invest $10,000 15 years ago, now you have $85,000. If you have invested 50% UPRO, 50% BTAL, you have $121,000. It's better, but not super impressive. Where it's impressive is 50% TQQQ, 50% BTAL. TQQQ BTAL combination works even better because BTAL works best combined with the volatile ETFs such as the TQQQ. So BTAL will help you to actively rebalance between one and the other. And when you do this rebalancing, you are basically taking profits from TQQQ and putting into BTAL. And then when TQQQ is underperforming, BTAL is performing better, and you take profits from BTAL and put it into TQQQ. You don't need to do this very frequently. In fact, here in our strategy, we are doing only yearly rebalancing. So it's not anything crazy. You don't need to do any day trading. In this strategy of combining TQQQ with BTAL, we'll have returned $346,000, which is 4 times more than the $85,000 of SPY. 4 times more, okay, 4 times more. But despite the fact that returned 4 times more in this 16-year period, or 15-year period actually, despite the fact it delivered 4 times more, the maximum drawdown was pretty much the same as the S&P 500. So the S&P 500 maximum drawdown, as you can see, it was 33.7%, and the maximum drawdown of TQQQ plus BTAL was 35.7%. 35% is not much more than 33%. It's almost pretty much the same, and the average drawdown is also not too different. So this is what I mean by getting much better returns, much better returns with similar volatility. This is what we call much better risk-adjusted returns. So for each unit of risk that you are taking, each unit of volatility, you get so much better returns. And check the chart of the backtesting here. SPY is basically the flat line at the bottom, if you allocate 100% into S&P 500, which is what most people do. UPRO and BTAL 50/50 is the red line, performs better but not outstanding. And then the yellow line is the TQQQ with BTAL. It's amazing, and it's a line that almost only goes up. And even the 2022 drawdown was not very large. The 2022 drawdown was only 35%. When I say only 35% is because when you compare it with the UPRO TMF strategy that had 70% drawdown, TQQQ and BTAL perform much better in terms of returns and give you half of the drawdowns. And this TQQQ BTAL strategy was brought to me by one of our community members, William. In the Henrique Wealth Academy, we are constantly talking about leverage ETF strategies, and William has shared this strategy a few days ago in the community. Thanks, William, for sharing this strategy. And I'm really proud of the Henrique Wealth Academy as a community because we really share everyday leverage ETF strategies that really work, and everyone is like-minded people that are looking to grow their wealth, grow their health also, and just get financial freedom and financial independence. So I hope to see you there, link in the description. So guys, I know that this TQQQ BTAL strategy is something that is not super common, is not very popular, but I hope investors get more awareness about this strategy. I talk about this strategy and many more strategies in my Henrique Wealth Academy. Check the link in the description. The daily conversation is only about how to build wealth with leverage ETFs, how to reach financial independence. And I have so many members in the community that already more than double their portfolios in a little over 1 year. And you can also find their 5 or 6 hour long leverage ETF course, my stock market course, and many more resources. So I hope to see you there. And in the meantime, give this video a like and subscribe, and I'll see you soon. Bye.